So here we are. Welcome to the July 2026 podcast, Counsel Mortgage Podcast. Thanks for tuning in. We're really excited about the podcast this month. We're going to be talking about commercial loans. As I mentioned, we're going to be going over there it is, recording in progress. So we're going to be going over, if you're looking to start a business, how do you get started? If you want to purchase investment property or office condo or apartment building or a strip mall or a gas station, how do you go about doing any of that stuff? You may just be you may not have any idea how you save the money, who you contact, how you go even get started. How much of a down payment do you need? Well, we're really excited that we have an expert with us today, Mike Green. He's been in the commercial lending world for over 20 years. How long have you been doing commercial lending, Mike?
Under this banner, 20, no, more than that now. It would be 20, I don't know, 25 or 30 years.
Yeah. He's been with Counsel Mortgage for about 13, and we're just tickled to have him with us. And he's going to kind of give us a primer, kind of help you figure out, hey, how do I get started? I want to buy all these businesses. I want to develop my own wealth. I want to develop investments. How do I get started? Where do I go? So Mike, why don't you take it from there?
Okay, John, thank you. Before I get started, I want to give a little shout out here and acknowledgement to Gwen Fowler of Lakes and Mountains Real Estate in South Carolina, who responded very encouragingly to John when he put out a little blurb here announcing that this was going to be going on today. And Gwen gave us a real let's go get them message by, I think, what you call Active Rain was the site. I think a real estate blog. So Gwen, thank you very much. Hope we justify your encouragement in us. Mike Green is my name. John asked me to introduce myself, so I think I did that. But a little bit about me.
And Mike, you may want to look up to the camera so we can see you a little better.
Well, then I can't see my notes, John.
You can raise them up maybe a little.
So anyway, yeah, I got my undergraduate degree from Purdue many years ago. I got an MBA from John F. Kennedy University out in California when I was passing through there. Experience-wise, out of school, I was joined the Air Force. I was a pilot there for 5.5 years, I think, officer and a pilot. After that, I got out, went to California, was a stockbroker, among other things, for about 11 years. And coincidental with that, did some investment banking for about 6 years at our own company, another fellow and I. Did some business and financial consulting off and on for 5 or 10 years, trying to decide what I wanted to be when I grew up. And later on went over to Phoenix and ultimately got a real estate license and became a commercial real estate broker for ultimately 25 years. I had my own company about 15 years of those 25 years. As a side note, specialized in gas station real estate and financing, an often overlooked segment. And coincidental with that, did mortgage brokerage with that. Did some of that as a business financial consultant also. So a little bit about me. If you add all those numbers together, they're going to make me look like I'm about 125. So some of those were done coincidental. Okay. Although I do have a few years behind me. I'm going to talk about loans today, commercial loans. And just as a disclaimer, I don't do residential loans. I've never done residential loans. I've done investment banking and commercial real estate and commercial lending and all this for whatever that added up to, 30, 35 years. But I've never done residential. So I'm not going to be equipped to do a point-by-point comparison for you with how these stack up in residential, because that's a blind spot for me. But I will tell you what I've observed about these. For starters, the glossary of terms in commercial is not what you understand them to be in residential. There's terms that you don't use at all. terms that you may know what they mean in residential don't really apply the same way in commercial. So just bear that in mind as I'm going through here. I may be talking about things that to me seem like everybody should know them, and maybe you don't. Don't feel bad about that. It's not unusual. In getting a loan, one of the things that John and I talk about is, what's a broker do here? Why do we need a broker? And the terminology here, what's a loan officer? And you go to a bank and you get a relationship manager, one of my favorite terms. And then you look at us as a broker and say, well, if you don't make the loan, if you don't do the loan, what do you do? And so the easiest way I found to describe that is if you go to the bank or go to a lending company and you go in and you meet with somebody in their office and they sit down and talk to you, recognize that they're an employee of that company. They work for the company. They don't work for you. When you go to a broker, and that would apply, I'm sure, to residential as well as commercial, we don't work for that lender. We work for the borrower. So we're employed by you, and our allegiance is to you. All of our activities are for you. They're weighed towards your interests, not towards the bank's or the lender's interest. So I think that's an important part to understand when you launch this thing. As brokers, we work for you, not for the lender. Lenders, if you go to a lender, it can be a bank or a non-bank lender, and you walk in the door and you want a loan, they're going to talk to you about loans. They'll have marketing names for them. It'll be loan A, B, C, D, whatever it is. And those loans were put together for the bank, for the bank's interest. They represent what they perceive the market demand for their money is, what the competition is, and of course, what's in the best interest of the bank. And they structure their loans according to those three metrics, those three variables. They don't take into consideration necessarily your interests, except to be able to sell you the loan. They want to make sure from a competitive standpoint that they get your business and not, lender B. Okay. So when they go through this process, the bank will end up with 3 or 4 different products, they call them. And those will be a very, very select types of loans that would represent maybe a niche. And they would talk about those as being our sweet spot. Maybe you've heard the term. Okay. In my case, when I was doing it, I was looking for sweet spots where people really wanted to lend on gas stations. Very, very few sweet spots for gas stations. Okay. But know this. So when you walk in, while all lenders and banks and what have you look the same, recognize they all have these products that are going to vary a little bit. When you look at their loans, their contracts, they'll have some standard language that is contractual. And then they'll have, when you get into the meat and the potatoes of it, where you get loan terms and conditions, those are going to reflect the variances that I talked about. Okay. So if you go in with opportunity from their standpoint, you go in with opportunity D, and they only have loans A, B, and C, you're not going to have a match. Not a very good match. Now, the loan officer, or whoever you talk to, isn't in the business of saying no. They don't, that's not what they do. So they'll want to qualify you and get you in the door and have you develop a package and go through the process, because their job is to get an application into underwriting or into the credit folks. Their job is then to evaluate it relative to what their sweet spot is and come up, yes, we can, no, we can't, or can we whittle it so it'll fit? That process for you will take, depending on the lender, anywhere from 2 to 4 months, something like that. And in the end, it may be, well, we really just don't have an interest in this kind of loan at this time. That's what it will be. So recognize that even though from the outside of the building, all these lenders, ABC Finance and Whoop-de-Doo Bank and whoever they all look the same. But once you get involved with them, they're not. In our role, our purpose as brokers is to know what the sweet spots are for these different lenders. So you come in and you want your gas station or your shopping center or your office building or your data center or whatever whatever you're financing, our role is to expedite that search to align you with somebody whose interests are the same as yours. It just makes the loan a lot easier, and ultimately it gives you better terms and conditions, and ultimately your cost. So that's a little bit of the process there. You can spend the time doing what we've already done, or you can have us do it for you. You can engage us. Okay. Kind of a couple of kinds of very, very broad strokes, two types of SBA, two types of commercial lenders. On the business side, there's SBA lenders, and then there's conventional or other lenders. And all other conventional lenders would include term loans. That's the fancy term for the loan like you usually get with a house. It's called a term loan in commercial business. You can also get bridge loans. You can get variable loans, construction loans, of course, different types of loans available for what you want to do. And again, all those commercial lenders have gone through the same thing that more formalized bank lenders have done. So even if you're dealing with a non-bank lender, you still are dealing with a company that has a specialty niche that they want to find, they want to occupy. Right? Except for the SBA loans, commercial loans are not regulated. You don't have the people coming out of the residential business want to see a standard loan, a standard contract. And the term standard really is not the term you want to use, because there is no standard. Okay? The lender may be regulated, that is a bank, but the loan they put out is not standardized to anybody's description. What you will come across is what they call customary and traditional. And that's kind of like everybody does it, but we really don't. So the brings in two considerations of that lack of regulation. One is you have a lot more complexity in your loans. You look at 3 loans ostensibly for the same property or business from the same lender, and you think they all read the same, and they don't read anywhere close to it. Yeah. That's the bad part of it. The variables are numerous. The good part is, though, because they are not standard, they allow for greater customization. They can be tailored in terms of terms and conditions to fit the borrower and the loan use that they're looking for. So you get a little bit of bad and a little bit of the good with this non-standardization stuff. One of the things that occurs if you cross the Rubicon and decide to go for a commercial loan, one of the things you should know is that the industry, the loan industry, the commercial loan industry and the residential loan industries are not the same. Okay, they just aren't, which is why I don't do houses. Okay. One of the things that the industry recognizes and allows, and when I say the industry, that incorporates all of the people that function within that industry, not just brokers, but attorneys, environmental consultants, appraisers, all the people up and down the pike. When you deal in the commercial business, the people you deal with are allowed to consider you what they call a sophisticated investor. And that's a terminology that comes over from the stockbroker business. Okay? So they deal with you in a little different manner than if you went to a residential lender, where you're not considered a sophisticated investor, you're considered a consumer. That difference allows people in the commercial business to deal with you differently. Now, they're not going to lie, cheat, and steal, but they're going to use a different vocabulary. We can assume that you have a different level of knowledge, of understanding, breadth and depth of what you're doing, and deal with you accordingly. If you don't have, and you're dealing with somebody that is talking a little bit over your head or outside your bounds, it falls upon you to question and say, hey, what are you talking about? I don't know what you're doing here. Okay? And that'll kind of put a pause in the conversation. Okay, so just be aware that it's not that the people are rude; they're just dealing with a different level of assumptions on the part of the people they're talking to. Okay, and all this is to kind of set the stage for you. if you decide to go down this path, kind of what's ahead and what are you looking for and what are you trying to do? Excuse me. Here we go. Okay. Of all the loans we're talking about, we'll talk about a few different types here, basically commercial and SBA. Any loan we discuss, we are able to broker commercial. So we'll talk about a couple different SBA loans. We'll talk about maybe a couple different types of commercial loans. And whatever those loans are, as a broker, we are enabled, entitled, and capable in brokering those. Okay. So again, in talking with you about what you want to do, we'll talk to you to try to identify who are we looking for, what do you want to do, and what kind of thing. So you want to have given some thought to that, besides saying, well, I own 4 houses. Now I think I want to buy an apartment. Okay. And how is that different? It should be the same. There's just more units, right? Well, no, not exactly. It's going to vary, but we'll be able to talk with you and narrow out. Well, probably my experience has been when I talk with people like that, there's generally questions that come up that they haven't considered. So if you don't have all the answers, we don't expect you to have all the answers. We're supposed to know the questions. You don't necessarily have to. Okay, compare pricing. John, you got that yield curve?
Yeah, sure.
Got a little graph here it made up for you with some scratches on it. And we're going to talk about this first because it comes into pricing. Pricing a loan, when you price a loan, we price it in terms of percent. It's not a dollar amount, it's a percent. So if you price a loan and a loan is 6%, that's called the price. It's the price of money, essentially.
See that okay?
Yeah, can you scooch it a little towards the top of the page? Is there a bottom falling off there?
Let's see here. Give me a second.
Or maybe I wrote this down after I sent it to you. Anyway, it doesn't matter. Okay, what you were looking at here is
that's all we got.
Okay. We got a U.S. Treasury yield curve, and I did this on the 24th, which I think was Friday. And if you look at this, you may not be familiar with it. The x-axis, the up and down axis is interest rates. That's the I. I do a lot of abbreviations, by the way. And along the bottom is maturity. It's how many months, M, or years, Y. The Fed funds, we talk about the Fed. The FOMC is the Federal Open Market Committee meeting, who, by the way, is meeting today and tomorrow. And they may or may not choose to raise, lower, or keep rates the same. We'll know that by tomorrow at this time. The current Fed funds rate is bid 3.50 and ask 3.75%. It is a bid and an ask. It's not a rate per se. They set the range. The prime rate, this is by the market. The market has accepted the prime rate to be the asking price plus 3%. So the prime rate today is 6.75. The Fed funds is a short-term rate. It's the rate that overnight deposits are paid or loans made, the overnight rate that banks pay each other for borrowing money. Okay, so it is an overnight rate, a short-term rate. So it shows up down there at RRP. RRP is the reverse repo rate. That's a little more exotic than what I just described, but it's a short-term rate. And the point of this is that the Fed funds, what the Fed does in raising and lowering rates, really only affects the short-term rates. So if you're dealing with prime or other short-term rates, you'll have an effect there of what the Fed does. So if the Fed wants to raise or lower rates for a soft economy or for inflation or whatever they're doing, it's really going to only affect the short-term rates, probably out to maybe as much as a couple of years, a year to two, somewhere like that. Over on the right side, you'll see there the conventional CRE. CRE is commercial real estate. Conventional CRE mortgage rate set by the market. What's the market? Well, this is the Treasury yield curve. That's where the Treasury bonds trade in a market. There's a market for that. Okay. The intermediate to long-term range, that would be about 5 to out to 30 years. That's where long-term rates prices are set. They're not set by the short term. The 10-year that I've got circled there, that tends to be the bellwether. That's what people who price loans, that's what they look at. What is the 10-year rate? Friday, it was 4.71. Okay. So if you get a loan that's going to be priced in the commercial real estate business, you're going to see a price on that generally of a fixed rate, be 10 years, 7 years, 5 years, whatever it is, plus a markup. Just like prime was the Fed funds rate plus a markup. Okay. So bear this in mind when you're looking at the difference between a conventional rate and an SBA rate, especially the 7A. We'll get into types of SBA loans, but the 7A, which is the most prominent that you'll come across, it's the most widely used. Those rates are prime plus a markup. Okay, but what the Fed does really doesn't affect the long term, or it may. Can't say it doesn't affect it. It's not a direct correlation to it. Used to be years and years and years ago that when the Fed raised rates up and down, the market raised rates up and down. We haven't had that now since about the fourth quarter of 24. So it's been a year and a half. Okay. For a lot of different reasons. I don't want to get into economics here, but the most recent Fed movements down have been met by increases in the long-term rate. So that's unusual, but it's been going on for a year and a half now. A lot of risk in the treasury market and interest rates at this point in time. So just be aware, though, that if you're dealing with SBA, you can understand that your rate is being driven by the short end of the market, of the bond market. And if you look across there, by the way, you can get this yield curve if you're interested. You can go to USTreasuryYieldCurve.com and you can pull up this very same chart. It does have a little, this again was done on the 24th. The chart itself, if you get it online, there's a little table of icons over on the left where you can click and you can go back and you can see yield curves going backwards. So if you want, you just start clicking that and you can see what it was, I don't know, going back years and years, I suppose. But you can see what it is and how it changes in shape. It doesn't give you a forecasting curve, though. That's something they don't do. All right. Okay, enough of that. Thank you, John. Get rid of that.
You got it.
Okay. Talking about conventional loans here. Leverage, typically loan to values for conventional loans going to be maybe 55 up to as high as 75%, 70. But clearly you see a lot of 65, 70% loan to values. All right. It's certainly not the 3% that you can get into a house with. So the equity in is going to be a steeper jump for you. The SBA, if we get to those, and we'll detail that a little bit more, by comparison, the SBA loan can go as high as 90% LTV. So when you look at leverage and you say, well, gee, I don't have that. I don't have my 30% down. I've only got 15% down. Well, if you're buying a business too, you can use that and buy the business. If you have both loans will generally allow for seller carrybacks. So whatever the primary lender is going to come in with at a loan to value, if you're still a little bit skinny on that, and the seller, if you're buying something, and the seller will carry a second, that's permissible. You can put that loan, you can put that package together. Okay. Use of proceeds. What can you do with the money? Conventional loans will typically limit you to commercial real estate. They will finance out an existing loan on the property. And depending on leverage and other things, you may be able to cash something out there. Cash out is a term where you walk away with some money at the closing table. Even though you've borrowed money and put money in, you can look at that as a cash out. SBA loans, by comparison, in addition to commercial real estate, they will finance equipment, inventory, soft costs, and soft costs are appraisals, environmental reports, inspections, traffic studies, commissions, things of that nature, drawings, if you have to have engineer drawings in there. They'll also allow you to finance or refinance existing loans, and cash outs are possible. So an SBA loan is going to be much more permissible in what you can use the proceeds for. If you're buying a business that includes the real estate, and you're going to use a conventional loan, they're only going to give you that loan to value on the real estate portion of the acquisition. So if you're buying a $300,000 business with a $700,000 piece of real estate, you need $1 million project. Okay. And you say, well, I've got my 10% or my 15%. The commercial lender is going to give you that, let's say, 70% of the real estate value. So if the real estate was 700,000, they're going to lend you 70%. They'll put in 490,000. Okay. That leaves you with, what's the arithmetic, John? 490, 510, 510. So yeah, so you've got the business portion of that, you've got to digest by yourself. Okay. Some people will try to split that and go to the seller and say, well, look, I'll pay you cash in this amount for the real estate, but you've got to support me and finance the business portion. If the seller will do that, you got a deal, depending on terms. So if you're buying a real estate with the business, there's a couple different paths you can go down there that can achieve success for you, depending on, right?
So just basics, Mike. Conventional loans, you'll need about 30% down. SBA, maybe 10 or 15% down.
Good rule of thumb. Good,
Okay.
good thing to go forward with.
Okay.
Okay. Residential and commercial. Some things that I can tell you about it. For commercial real estate, due diligence and transaction expenses will both be more and longer and higher. Documentation will be more thorough, and time of transaction will take longer. Just rules of thumb. Okay. So whatever your time frame and dollar amounts were for a residential transaction, they're going to be extended, and you'll see why take that long? Why does it cost this much? Why do they need that? All that stuff will come up? Okay, so you're in a different setting for commercial, whether it's commercial, conventional, or SBA. That'll be the case. The B in SBA stands for business. Okay. SBA loans were meant to facilitate small business startups and transactions. If you don't have a business, you can't use an SBA loan. So if you have a business with the real estate, great. If you have a business only and you're going to be a tenant, that's also great. You can get a business loan, an SBA loan, for the business only. If you have a commercial piece of real estate with no business involved, you're not going to get an SBA loan. So just bear in mind that you got to bring a business somehow. You got to get a business in there. If you're buying a vacant piece of property that's commercial and no business exists, and you start a business, you can use an SBA loan for that. Okay. But business has got to be part of the transaction somehow. If you want to buy a multi-tenant property, let's say you got a nice little 9-space strip center out there somewhere, and you want to buy it with an SBA loan, you can do that as long as you, as the owner, occupy 50% of the space plus 1 foot. Okay, so if that's the case, you may want to get a two-space area, or you might want to get an industrial building with 2 units, anything where you can occupy it. Again, if you don't have a business, you can start one up and put it in there, and that'll go through. But you need to have a business interest in that property. Commercial loans, conventional commercial loans, are unregulated. No standard terminology, customary and traditional rules. There'll be glossary of terms there you won't know. If you don't, ask, because the people on the other end won't know what you don't know. They'll assume because you're talking to them that you have a certain level of knowledge about what we're dealing with. So it behooves you to go in and be ready to ask questions, and ask a lot of them. And we're used to it in most cases. Conventional loans you can look at them as being bank and non-bank lenders. There's a lot of lenders for conventional real estate that are not banks. They can be private lenders, other finance companies. Because again, there's no standard. You don't have standard terminology. You don't have standard contracts. Arizona Department of Real Estate. When I was in there, I was a commercial real estate broker in Arizona for 25 years. So when I left, about the last 5 years, I think, before I quit that business, Department of Real Estate tried to come out with a standardized commercial contract. They've had standardized residential contracts for light years, but nothing commercial. So they tried to come up with one commercial. It's meant to hit the 60, 70, 80% of all commercial transactions. Most commercial real estate brokers, if all they do is commercial real estate, we all had our own contracts. They were written for us, by us, for the sweet spots we occupied. Okay. So again, if you're going to deal with a generalist, a commercial real estate broker who is a generalist, not a specialist, particularly in commercial real estate or a niche of commercial real estate, and you go to contract with them, you may very well get presented with a standard Arizona commercial real estate agreement. You won't get that, though, for the commercial financing. You can get it for the real estate. That's what it was just. I'm sure they haven't terminated that yet. Okay. The other thing about commercial real estate finance people, they're hard to find. Banks, you know, if you go to Citibank or Wells Fargo and you go in and you say, I want to buy a piece of real estate, they'll shuffle you down the hall. And you go to a commercial real estate broker who, when he finds out you want to buy a business, will shuffle you further down the hall to the SBA window. That's where you'll end up. Okay. If you don't want to buy a business and you want this commercial real estate, many times they might qualify and you say, well, how much do you want to buy or what do you want to buy? And if you're not ringing the 10 million or more bell when you say that, you're going to be put down into the SBA arena, or you're going to be said, well, we really can't help you too well. So now you're looking for maybe a private lender. You might try Googling. Everybody wants to Google. We'll Google private lenders and see what happens. They're hard to find. They're hard to contact. They're hard to talk to. You go to the websites and they're under construction. They're a particularly opaque part of the industry is private, commercial, conventional lenders. They just fall in the crack. So you can try to find them. Just be aware that there's not an easy directory that comes up that really gives you much. And what does come up sometimes isn't all that helpful. Okay. All right. Talked about that. Oh, yeah. Term.
Mike,
Term
so Mike, so Mike, let's go back a little bit and spend a little time on the types of loans that are available. So if I do a commercial loan and I can put 30% down, it's not a 30-year fixed mortgage, right? How long is the term? How long is it amortized? How is it determined?
That's my next note.
See, and we didn't practice this beforehand.
This was just not rehearsed, ladies and gentlemen. just wise minds thinking alike. Okay, typical terms. Typically, you'll see them 5 to 15 year amortized. 15-year term, pardon me. 5 to 15-year terms, and they'll be amortized anywhere from 10 to 30 years, something like that. They may be fixed. They may be adjustable, not variable. Adjustable. Get a 10-year loan, it might adjust in years 3 and 7 or something like that. Okay, where they'll market to the market at the time. Amortization periods will be, again, 15 to maybe 30 years. And so if you look at that and say, well, I'm not paying off my loan at the end of the term, what happens? Well, you refinance it. You don't, most people don't buy these things with the idea of ever paying off a loan. They just roll it and roll it and roll it until they're done. Interestingly enough, when I was in the business dealing with gas station owners in Arizona, the typical holding period for a guy to own a gas station was about 7 years. And most of those were done on SBA loans that ran 30-year amortizations. Okay? So when you get ready to sell it, if you're selling it, you're going to have a loan out there. Just plan on it. Okay. So you're going to build up your equity though, because one, the price of things just goes up. That's inflation. And secondly, you're amortizing your principal down. So you will develop equity in this. So when you do sell it, be it 5 years, 10 years, whatever, you're going to have some equity more than you started with. You should have. And you'll also have a loan that has to be dealt with. So just be aware of that.
Are there prepayment penalties on those loans, Mike?
We'll get into that. You're ahead of me. Yeah, generally conventional loans will have prepayment penalties. If you get a 10-year loan, the prepayment will maybe run for anywhere from 3 to 7 years. Sometimes I've seen 10-year loans that have prepayment penalties all the way through the term. So you may have. I'm going to talk with you about that a little bit further on down. But yeah, prepayment penalties are something to look to. The lender plans on having the loan out for a certain period of time when they make it. So they plan on that money being tied up. They run their profitability on any loan based on it going full term. If you interrupt that term, that interrupts their financial projection that that property would or that loan would give them. And so your prepayment penalty is exactly that. It's to make them whole for the period of time they won't be collecting interest on that money. They got to replace it. So that's what the prepayment penalty is for. Some lenders will, in your term loan, when you get it, sometimes there'll be a provision there, a term in the contract that says this is extendable or renewable. They'll use that term. Okay. That's something nice to have. Some people feel good about that. Effectively, what they do, if you do renew it, they're going to go out and they're going to re-underwrite the loan at that time. It's an option for you. They're telling you we'll renew it, but they don't put in there that you have to renew it. So at the time the loan is due, they'll offer to renew it. They'll typically contact you 6 months before it's due and say, hey, you're going to come up for maturity here in 6 months. I'm going to get a renewal option out here for you, and we can take care of that. And they'll do that before it's a month or two to go. Hopefully they don't, if it's successful, if it's a good loan, you're on time, no problems with it, they'll want to keep that money in play with you. Alternatively, you may take that as a stimulus and say, oh, I got to go out here and shop for this loan again. The path of least resistance will be for you to roll it over with whoever you've got. You're a known item. It's easy. Why make it hard? Okay. I generally counsel them that it's a good idea to go out and check with a couple other lenders and see what else is out there at the time. Okay. It's kind of like renewing your insurance policy. None of us want to do that. We just want to roll it with the same company. I don't care if so it's $1.98 more. It's not worth my time. In commercial real estate, it's worth your time. Let me tell you, because markets change, lenders change, loans change, everything changes.
No, that's a good point, Mike, because a lot of people, they'll just go right with the same lender. They don't even know they can come to us and we can shop it for them and see if we can get better terms for them.
Yep, all that. Okay, lenders. Talked about a sweet spot. Lenders have that sweet spot. What kind of loans do we want to make, they say to themselves. And they will profile the market, areas that they consider geographic areas. Where do we want to be? In that, it may not be this neighborhood, this city, this town, this state. It may be generic. In other words, we'll only do metropolitan properties. We'll only do MSAs of, 5 million or more, for instance. Type of properties. Do you want offices? If you want offices, do you want medical offices, engineering offices, specialty offices? If it's retail, what kind of retail? Do you want strip malls? Do you want neighborhood malls? Do you want big boy malls, I call them? Do you want standalone buildings? Do you want fast food properties? Do you want single tenant properties, such as bowling alleys, movie theaters, gas stations, laundromats? What do you want? Size of the loan, how big a loan? Most lenders you talk to for commercial real estate will have minimums of $1 million. $600,000, you're not going to find a lot of conventional people interested. Okay? Do you want a turnkey loan, or are they going to make turnkeys or value added? Value added is a fancy term that means it's a turnaround property. It's been let go. It's got questionable tenants. It hasn't broken even on rents for 5 years. Deferred maintenance on it. Those are turnaround properties. Turnkey properties is everything works great. I have the average tenancy remaining is 7 years. The property just had a new roof. I have no vacancies. That's a turnaround. Okay. So they'll want to know what kind of loans we make. What kind do we want? We as the lender, what do we want? Property historical financials. If it's an idle property, a dark property, it doesn't have historical financials. That's a high risk property type for a lender. And you're going to come in and say, well, yeah, but I've got 5 cousins and 2 nieces, and they're going to take all the property for me. And they're going to say, well, yeah, what rates? So you're going to have to put together your own pro forma. Pro forma, if you're not familiar with it, it's a fancy term for financial projection, called a pro forma. Makes us sound smart. John uses it all the time.
I still keep practicing.
He is smart. What's the quality of the tenants and the quality of the leases? What are the terms of the leases? How forgiving are they? If they're retail, do you have it in there that you've got annual bumps to keep up with the consumer price index or whatever index they're using? Probably the most important things that we don't look at away from ourselves if we're out here looking. The thing that most lenders look at that is most important to them is called the quality of the sponsor. And the sponsor is you, the borrower. They're going to look at you heavily. They want to see not just your credit score and not whether you got 3 months of paychecks or not. They're going to look deeper at that. They want to see your experience in the business, if any. And the business is managing properties. Because if you have commercial only and you're renting it out, how good are you at renting? And if you're not going to collect the rent yourself, did you build into your pro forma an expense to pay a property manager? Okay. So the strength of the sponsor is a big thing that they look to. If you are going to go and get a commercial loan or a business SBA loan, you will be asked to present a business plan, typically 3 years, sometimes 5. And the business plan is going to be dovetailed with a pro forma projection for that same period by month, at least by month for the first maybe 3 years. If they go out 5, they'll let you do an annual after that. But you're going to have to do some homework on what this property looks like. How is it going to financially project? Okay. They want to know that you can cover things like debt service coverage. Going through this process, you turn in your pro forma and your business plan, and you get a call from the lender that says, we can't do your loan because it doesn't cash flow. It doesn't cash flow. What does that mean? Exactly. What they're looking at there is ratios. And they're taking a look at what is called the NOI, or if you're buying a business, that NOI term is called seller's discretionary expenses, which is kind of an adjustment to what they call adjusted cash flow. So that terminology thrown in here for accounting purposes, but basically they're going to look at the size of the loan in comparison to your income, to the income that the property will generate, right? And they're going to come up with a ratio. Typical debt service coverage ratios, SBA uses 1.2 times. And that basically says if you've got net operating income of X amount, but you've got a loan payment of this amount, divide that out, it should be 1.2 or more. And all it says is you've got that loan covered 20% more than it actually is. So they're allowing you 20% leeway in not being able to make your projection. And still being able to pay them. The lender's interest in this is not that you are successful managing and making money with the property. Their interest is making sure that you can pay them their note. Okay, that's all they're interested in. If you have any money, so much the better. But if you don't, that's okay too, as long as you can pay us. So it's simply a method. When they say it doesn't cash flow, it means that ratio was too low, which means you either have to get a smaller loan or you have to make more money on it somehow. And if it's a turnaround, it's not going to cash flow. That's why it's a turnaround. Okay. So if you have a business plan and you've got, maybe this is your nth property that you're doing this with, and you've had success in 2 or 3 before, and you want to do it again, and they know that, and you can document that, they'll roll the dice with you. And then the type of loan you get will want to reflect that. Maybe you don't want a term loan on a turnaround. Maybe you want to do it as a bridge loan. And once you turn it around and stabilize it, then go out and get your permanent loan. Okay, so there's different strategies here in using finance as part of your investment strategy, more so than you generally come across if you're buying a house. Okay. Cap rates and swaps. I don't know if they want to. I'm keeping an eye on the time here, John. I'm kind of sensitive to that for you. We talk to SBA loans to people. People would come to me and want to buy a gas station. I'm talking to them and say, well, the way leverage works, you're not going to do real well with a conventional loan because there's a business. The kind of loan you want is SBA. And they throw their hands up and say, oh, not an SBA loan. Those are terrible loans. My cousin had one. They tried for 6 months to get one, and they couldn't do it, and it didn't work well, and it led them down the path of producing financials forever, and you just couldn't get it. I don't want to do an SBA loan. Why is that? Well, I'm going to tell you. In the SBA world, there's 3 types of lenders. There's what they call preferred lenders, accredited lenders, and then there's everybody else. Okay? These lenders are seen within the SBA. In other words, the SBA looks at these lenders and they grant them those credentials, accredited or preferred, based upon a lot of metrics that the SBA applies to them. Okay? What you want to know is the by and large, the bulk of humanity doing SBA loans are generalists. That is, they'll take the application, they take it, package it up, and they send it to the SBA, the regional office, and the SBA does the underwriting, and it comes back. All this stuff takes time. It takes time for you to do it, maybe a couple of weeks, maybe a month. The lender gets it, they put a cover sheet to it, send it to the SBA. The SBA takes 2 to 3 weeks, comes back and says, we need an update in financials because they want them within 60 days. And by the time they got to it, it had already exhausted the 60 days from the time you gave it to the lender. So their lender's going to come back to you and say, I want to update financials. You say, well, what for? And they tell you that, and you say, okay. And so you do an update on your financials. You give it to the SBA, and the SBA comes back and they want more information. And the lender comes to you and says, I need more information, whatever that is. And you say, okay, and you give them more information. This process goes on for maybe a couple, 3 or 4 or 5 months, something like that. And then it comes back and the lender says, well, I'm sorry, it doesn't cash flow or whatever. The point is that generalists don't do their own underwriting. The SBA is underwriting your loan. If you want a loan for a type of business and property that the guy at the SBA regional office doesn't happen to know or like real well because he got stung on one 2 years ago, he's not going to look user-friendly to your loan. The lender that originates that loan has nothing to do with the process. All they do is intermediate the documentation. Okay? Those are generally the kind of loans that your brother-in-law had that went through this for 6 months and didn't get his loan. Okay? The lender, the loan officer at the bank, doesn't really do anything with your paper except pass it on because they have a conflict of interest. They can't look at your pro forma, edit it, check it with the business plan and say, this doesn't match. This isn't it. There's no barrier between your application and the SBA's determination. I learned this early on, long before I worked with John. One of the things that a broker can do, again, we work for you, we don't work for the lender. So one of the things that I came to do is that I would be the first source of editorial opinion on your business plan and on your pro forma. I see it before anybody else does because I know what they look for and because I know. Okay. So that's the experience. If I worked for the bank and I knew exactly what I know now, I still couldn't work for you. It's a conflict of interest. Okay. So bear in mind what I'm just telling you here. If you want to cut out the broker, go to a preferred lender. Find your preferred lenders. It's a question to ask. Anytime you go to an SBA lender, ask, are you a preferred lender? They know if they are or not. Okay. An accredited lender is kind of in the middle there. They can do a little of the underwriting, but not all of it. So you're kind of a little bit there, but not all the way. From my desk, if I work with an SBA 7A lender, it's going to be a preferred lender. I inventory these things. I've been doing it since I've been with John and before that. There's not a lot of gas station SBA lenders, I can tell you that. But there's a relatively few portion of preferred lenders. So the question, if you're calling the lender directly and you're shopping that, one of the first things you want to ask them is, are you a preferred lender? And they either are or they're not. And well, we were, but we decided not to be. Well, that's because they screwed up a file and the SBA took their preferred ranking away from them. Okay? They compete better as a preferred lender. Doesn't mean they make more, it just means they compete stronger. Most preferred lenders will have a sweet spot. They won't do all things to all people. And that's what makes them preferred, among other things. Okay? So you want a preferred lender, and then you want a preferred lender whose sweet spot is in the type of property and business that you want to buy, be it a gas station or a fast food franchise or tiddlywink parlor or whatever you want. Okay, so if you're going to lenders, just bear that in mind. SBA loans are good loans. They can be done well. They're going to take longer than a home loan. I'll tell you that. But you want to find somebody
I think the time frame
get it for you.
Yeah, I think the time frame for SBA loans right now is about 45 to 60 days is what I hear.
Okay. Okay.
Hey, Mike, can you explain the differences between a 7A SBA and a 504 SBA loan?
Yeah.
How do you do that, John?
Yeah.
Okay. A 7A loan is relatively simple, straightforward. You go to a lender, they lend you the money. The lender is lending the money. The SBA is not lending you the money on a 7A loan. The bank lends you the money. The SBA insures that loan for them. In that process, that insurance policy, like all insurance policies, has a premium. That premium is what you, the borrower, pay at closing. Okay, that's your insurance policy for the lender. Right? So that's what the SBA 7A is. Pardon me?
The SBA fee.
That's
the SBA fee, right?
It's a guarantee fee, they call
Guarantee
it.
fee, yeah.
Yeah, it ranges. It's a function of the size of the loan. It's typically 1.5% to maybe 2.5%, something like that. Okay, one-time loan fee. You pay it once, you're done. But that insures the loan to the lender. So if you default on it, the lender picks up the package, sends it to the SBA, says it's defaulted. They stamp it defaulted and send the lender the amount of money that you owe them. Okay. A 504. 504 is, first of all, it's more complicated. It's a more complex loan. It's usually used by established businesses that want to expand what they already do. They want to open up bigger offices or more geographic areas or do something. But they're generally established as a business and they want to do bigger and better and more. Okay? Don't have to, but they do. An SBA, a 504 loan is really two loans. There's one loan that's made by the SBA directly. Okay. The other loan is a conventional commercial real estate loan by a lender, like a bank, like you would go out and find a lender. Okay. So a 504 loan involves three parties, right? A bank, a conventional bank that's going to do a conventional loan, the SBA that will do that loan I'll talk about in a minute for debentures, and then you, the borrower, that have equity. So there's three sources of money. The SBA loan portion is going to be limited to 40% of the loan amount, the maximum of $5 million. So if you take 40% and say $5 million, how much can the loan be for? And you work the arithmetic, the loan size for a 504 can be 12 point, not the loan size. The project size for a 504 can go to $12,500,000. Okay, much greater than the $5,000 limit on the 7A. So if you've got a 7 or 8 or 10 or $12 million project with a business and you want that SBA type of loan, a 504 will get you there. All right?
And the 504 is in the second position, right, Mike? Oh,
Yes.
Conventional would be in the first position.
Yeah, the conventional lender, the bank, they get the first deed of trust or the first mortgage. The SBA is in the second position. Okay. So you look at that, and those combined can be 90%. Okay. So 10% can be or would be the investor or the borrower's amount. So that 10% can go up to $1,250,000. Okay. So if you're going to do loans of $6-7 million or projects of $6-8 million or more, up to about that $12.5 million, a 504 is what you will do, but it's more complicated. Okay. Use of proceeds. A 504 loan is generally going to be limited to the real estate, other fixed assets. Think in terms of plant and equipment. You put in an assembly line in a factory, that would be part of it. CapEx, some soft costs, but it's generally a real estate loan. What it can't be used for is inventory, working capital, and refinancing existing debt. Okay, so the 504 is going to have restrictions on what you can do with the money. Okay? The rates. The SBA, talk about their 40% portion. They're going to commit to 40% of a project. They get that project done, and they're going to take that loan commitment that they're making, and they're going to turn it into what they call a debenture, which is very similar to a corporate bond. Okay, they're going to take that corporate bond and they're going to take it to that debenture, and they take them to market. They bundle them up. This would be the SBA. They bundle those up periodically, about every 6 weeks, and they take the package of these SBA debentures to market, and they auction it off, not unlike the Treasury would auction Treasury bonds. Okay, so whatever rate the market sees at the time of that auction, that becomes the interest rate on the bond. Okay, that isn't done until the loan is underwritten and committed to by the SBA. So how do they do that? The banker who does the conventional part, he prices his and says, great, it's going to be 6%. And the SBA estimates to the borrower, we think we're going to be at 6%. We think, but we don't know. And your 10% is this much money. And then they close the loan. They do a condition, what they call a conditional close. Okay, because they don't really know what the SBA's portion is yet because it hasn't been to auction. They've got to turn it into a loan before they can, what they call securitize it. And this auctioning process is securitizing loans. So they go out there and they auction it and say it's about 6%. Well, it comes back 5.97 or 6.01 or some other amount. Well, how do they adjust that then? They got to go back and reclose the whole loan? No. When they close the loan and create the debenture, there's a period of time between the loan closure and that auction. What happens with the money in the loan during that time? The conventional lender who's doing the first puts in an additional bridge loan for that debenture. Okay, and they price it at whatever the bridge loan is. It can be 6%. So the bridge loan is in place. They create the debenture. It goes to auction. It's auctioned off. They come back. Because now they have the proceeds from the auction. That pays off the bridge loan. They make an adjustment to the conventional rate so that the combined rates are blended, because you'll have a blended rate on this kind of process. You'll have 50% at 6% and 40% at 5.98%, and you put them together and you get a blended rate. So in the auction process with this financing, that's the gymnastics that makes it work. Okay, that's sometimes to the borrower a little unnerving. You mean I'm going to sign up for $10 million of debt and you can't tell me the rate? Well, that's what they're going to tell you. Well, I can't do that. I mean, that's just, why'd I even go down this path? Mike, you dummy, what are you doing with me here? So, but that's how it works. And that's one of the unfavorable things about 504s is that they have this methodology in putting them together that is confusing, is a little unnerving. Usually those debentures, they usually go out at 25 years. They can create pools where they've done 10 and 20 years. So there's some flexibility in putting these together because the project they're doing, of course, is going to have a pro forma. And the pro forma is going to show a certain amount of debt service coverage. And so they look at that and say, well, we can't do that in 20 years, but we can make it work in 25. Okay, so there's that. One last thing on 504s and 7As. I told you this, maybe I didn't get this to the 7A. The 7A prepayment penalty it's a 25-year fully amortized. The prepayment penalty is 531. What does that mean? 5% in the first year, 3% in the second, 1% in the third year. After 3 years, there is no prepayment penalty. So after 3 years with 22 years yet to go, you can refinance that all day long without penalties. Here comes the 504 loan on a 25-year AM. The prepayment penalty is 10.987654.321. So you're not going to prepay that off before 8 or 9 years at the earliest. Okay, so it's not a forgiving loan in that context because it's going the way it's going, though, with the debenture and the conventional first. Those are fixed rates, fixed rate terms. Okay, so they go the fixed 25-year or whatever it is. The SBA is a variable rate at prime plus a markup. The maximum markup is 2 3/4%. So most of them go out the door at 1 3/4 to 2 1/4, call it 2%. So prime today at 6.75 plus 2% would get you an SBA variable rate loan at 8.75. That varies every time they change the prime rate. So when the Fed meets every 6 weeks, they adjust the Fed funds rate. If they make an adjustment, that shows up the next day as the prime rate. That payment on that loan adjusts accordingly the next payment period. So you're on a variable schedule. So if you're catching a 7A loan in a rising interest rate environment, you're probably not happy with that. If you have an uncertain environment like we might have now, or one where we're thinking rates will go down, and you take a 7A loan at whatever today's rate is, and the Fed cuts the short-term rate, your rate's going to go down. It makes no matter mind what the long-term market is for treasuries. Bond market go nuts and run the 10-year bond up to 10%. If your prime rate is at 6, doesn't matter what that is. Okay, so the variable versus the fixed and the prepayment period are important terms in looking at those two if you're weighing those alternatives. And if you ask the broker, you ask your loan officer, ask me, well, Mike, which one do you think I do? I'm going to say, well, I don't know. What do you think interest rates are going to do? Well, I don't know. I said, well, I don't know either. Right? But here's the best way to protect yourself. So what you're looking for in an environment of uncertainty, which we have, is the best trade-off of risk reward. It's not necessarily the lowest payment. Most of the time I get a borrower in, and the first thing they want to talk about, what's the price? What's the rate? What's the rate? That's all I hear about. What is the rate? Well, you can't get a rate until you kind of fill in the rest of these things. You might start out with a rate, but by the time the loan closes, the rate is not why it closes. It's the terms and conditions that dictate the loan. Okay, so now I'm out of ammo, John. I ran over. I'm sorry.
Let's one thing. When you apply, I want to go over the process, Mike. Appraisal, environmental, whatever. These are things that are new to people that are getting into commercial loans. So when I come to you and I want to apply for a loan, and maybe it takes 60 days to close, what are the things that are going to take place during that time? Let's say I'm buying an apartment building. So what's the process like? What are the things that are going to take place during that time frame?
Well, the first thing we're going to do is determine the feasibility of what you want to do. And so we go through and I'll have questions. And we got a whole worksheet, a form of questions to ask to see what you want to do, where you want to do. But let's say we arrive at an apartment and you're going to buy one in Mesa, okay, for however many dollars. First thing I'm going to get you is in that feasibility, I'm going to get you an exclusive representation agreement. Okay, that's basically where you hire me. Okay, and says, I'm your broker. So once I'm your broker, now I work for you. Contractually, that might seem uncomfortable because I don't think you probably don't use those in residential, do you? Or do you?
No, they're not allowed.
No. Okay. So you're going to hire me because I'm going to go to work for you and I'm going to represent you. And a lot of the conversations I have with other people on your behalf, I need to be able to say, I represent you, or I work for, or I have a buyer or a borrower who. Okay. If I don't have that contract, that agreement, I'm misrepresenting you to whoever I'm talking to. Okay? So that's the first thing that goes out, and it says you're going to hire me, and there's going to be a fee in there. I'm going to work for typically 2% on a conventional loan, 1% on an SBA loan. Okay, those are financeable generally. Part of that money on a conventional loan goes to the lender. We don't keep all of it, but there's a fee schedule that goes with that. Once you decide that that's what you want to do, then I'm going to get you a loan application that's going to be suitable for the type of loan and to the lender we're going to go to. Okay, and that's going to be fill in the blanks. There's going to be a personal financial statement, a few other things. Okay, it's generally, it might have a preliminary document request list, and that's pretty pablum. One of the things
It's the personal financial statement, which is a list of their assets, their liabilities, the properties that they own. They're going to put this all together in a personal financial statement. Plus,
yeah,
they're going to need at least like 3 years of tax returns too, right, Mike?
not at that time.
Not at that time. Okay.
I'm not going to bleed you dry until I need to.
Okay.
Okay. So I'm going to control the process with the lender on your behalf. And because I know the lender and what they want and when they need it and what they need it. A lot of people want to give everything to the broker at one time and be done with it. It's like force feeding a baby with a steam shovel. It all falls on the floor. Okay. So there's a timeliness of getting information, disseminating it, getting response back, getting them more to do. There's a process there. So anyway, we'll get that. I qualify the borrower first. And I do that. We call it circling interest. That's an old stockbroker term, but I shop the loan on your behalf. And I talk to lenders that I think are reasonable. I go through my lender list and I say, oh, here's my apartment lenders, and here's the ones that like to do metropolitan only, and here's the ones that are in Indiana, where am I? Arizona, and so on. So I do a little preliminary match of the borrower, the type of loan, and the property until I can get a short list, maybe 3 to 5. And then I'm going to go back through them and I'm going to tighten the screws on them a little bit to see where do we want to go. Okay. You don't, a lot of borrowers out there think I need to go through and I need to get 5 lenders out there and I need to give all of them loan packages and I'm going to shop and they're going to give me rates back. And they're not going to get it. They just won't get that. It doesn't work that way. Okay. So it's a little bit of a time dump on our part. Okay. That's where being able to pre-qualify it and have a pretty good idea of what can go and what can't in structuring the deal. A lot of people come with will come with properties already in escrow. They'll go out and they'll negotiate the contract and they get closing costs and they get whatever they get in this real estate agreement without ever having talked to a broker, a finance broker. Okay. And so sometimes what I tell people, again, when I was a real estate broker as well as a lender, I would tell them, you don't go put your real estate deal together in a closet and then come out and show it to the light of air and have somebody come up and they'll tell you, well, this isn't bankable the way you've done it. You need to have this and this and this and this. Well, he already beat the seller to death. The seller's not going to want to change that contract at that point. So if you're buying something, it's a good idea to include your lending source while you're in the process of buying what you're buying, because you want to put a deal together that's a bankable deal. And a lot of people would come with something already in place and it wouldn't work. And it didn't cash.
So then you have that, you submit it to the lender. Then what's the next step?
Lender gives us a pre-approval letter called a term sheet. They'll give you something, say, well, if all this works, here's your loan. It's this much at this rate for this maturity and on down. You look at that and it's a term sheet. And it's going to be subject to all the contingencies, subject to an environmental check, subject to appraisal, subject to, fire inspection, subject to all the inspections that come out. Okay. And those are contingencies that have to be cleared. So that term sheet goes to the borrower looks at it, and what they're looking for is how much money and for what interest rate. But I walk them through there, generally anywhere from 3 to 7 pages. Okay.
And once again, at that time, the lender may provide an interest rate, but that may not be the interest rate when you get to closing. It's different than residential because
they tell you that you're not locking a rate at that point.
That's right.
Okay. So they tell you rate is not guaranteed. This is what we think it is today. Because again, from the time you get that term sheet till it closes, might be 3, 4, 5 months, depending on what you find. Okay. So that's going to call for a good faith deposit, and that's going to be generally enough to cover the lender's inspections. So the borrower doesn't go out and get his appraisal or get his environmental phase 1 or get building inspections or get these other inspections. Okay, the lender is going to do that because the lender has a list of pre-approved providers of those services they go to. Right? So the deposit, they say, well, the appraisals are going to be $3,500 and the phase 1's $3,000 and building inspections $2,700, and they add all that up, and that's the good faith deposit from the borrower. So the borrower signs that.
What's an environmental phase 1?
They go in and make sure, depends on what kind of property it is, but basically they look and see if your residential property, is it old? Does it have, what am I thinking of? Insulation, asbestos. If it's an old property, does it have lead-based paint? If it's a gas station, does it have leaking underground storage tanks? If it's a laundromat, does it have containment for, I forget the contaminant. But basically a phase 1 is an environmental audit of the property for all the bad things that the EPA says we want to be careful of. Okay. So, and that's going to be, it doesn't matter what the property is. Lenders have gone to the point where if you want a commercial property, it's going to have a phase 1. It's that simple. Not for discussion. It's just a matter of who does it. Okay. So they're going to cut a check.
The deposit. Yep. You've given the deposit.
Cut a check and send a check with the accepted term sheet to the lender. The lender's going to get this, acknowledge it, go out, and they're going to start those reports in there somewhere, because what's going to happen is the lender now has a pro forma and a business plan that's anywhere from 2 weeks to 2 months old. Okay. So these environmental reports start coming back and they're checked off. They look good. They look good. They look good. This looks good. And now they're ready to close the loan. They've done their due diligence. They've done the feasibility. They'll go out and they'll tighten the rate. They'll price the loan at that point. They'll come back and say, your loan, here's your unconditional loan closure commitment, and they'll give you this is your note. And that will come to the borrower, and the borrower is going to look at it and compare with the, here's my term sheet and here's my loan. How do they look? Looks good to me. And you're done.
And that process could be a couple months, could be longer than a couple months, depending on what you're purchasing.
Realize the lender's dealing with third parties. So that environmental consultant isn't waiting around for that call. He might be able to schedule this in 3 weeks. The appraisal can be out in 2 weeks. Building inspector for what kind of building? Well, it's going to be different. If it's an industrial building, it's going to be different than an office building. Okay. So the lender is not responsible for timing on these because he's got to deal with other companies. Okay. So there's some gymnastics doing that. Through that process,
costs are more than a residential because, as you mentioned, the appraisal cost can be a few grand, and Well, the borrower is going to have to go back a lot of times. The borrower needs to tweak his financials, his historicals. He's got income statements, balance sheets, whatever, from his accountant, but maybe he's never looked at them. He got them, signed them, paid his taxes, and went on. Okay, so I take a look at the financials, and if it looks like it's got a hole in it or needs some tweaking, I'm going to go to the borrower and say, who's your accountant? Do this and this and this with the accountant. Or if you sign this letter where you authorize your accountant to talk with me confidentially on your behalf, I'll intermediate for you and I'll deal with this stuff for you. And they have a choice. Okay, so a lot of times we'll get updated financials. I'm not an accountant. I'm not an auditor. I'm not a
environmental consultant on none of these things. But I deal with all these people on behalf of the client. So once upon a time, I worked for an environmental consulting company there in Phoenix, doing underground storage tanks. I used to build gas stations once upon a time as a contractor, estimator. So just enough to get into trouble, not enough to get out.
Yeah.
So
there's a process, and the process is a little bit longer than what people, in residential, you can get done in a few weeks, 30 days, but not in commercial. There's more involved. It's, as Mike mentioned, usually it's more of a sophisticated investor. There's more information. Do they necessarily need to have experience in the area that they're looking to try to get a loan for, Mike?
they don't need experience, but they need to be involved. I can do these without them, but I try to involve them at the point where they need to know what's going on, and they need to expand their learning curve if they have one. Okay, I can't make decisions for them. Okay, I can't sign for them, but I can audit things. I can look at financials. I can look at phase ones. I can understand phase two, phase threes.
So
I understand appraisals.
So if I want to buy a franchise and I've never owned a franchise before, that shouldn't prevent me from trying to buy a franchise. That's something I may be able to do. Get SBA financing or what have you.
Well, I've done franchises over the years. Gas stations usually aren't franchised. The fast food you find in them, however, are. The tire store up in Kingman that I did before I left was franchised. There's probably other franchises I can think about. True Value.
So you don't necessarily need the experience to buy a franchise and get financing.
That depends on the franchisor. Okay. Yeah. So, if you're going to go out and you want to, you'd like to open restaurant of some sort, maybe a specialty restaurant, maybe a popcorn franchise. I don't know what they've got. There's well over 2,000 franchises you can buy.
Oh yeah.
So what do you want to buy? You can go out there and you can find them. I've dealt with many kinds. A lot of things that a lender will want, and some lenders, SBA particularly, depending on the terms of the franchise agreement, some lenders won't finance a franchise, SBA. And it has to do with how restrictive the franchise covenants are. If the franchise is ARCO AMPM was a classic. ARCO was the gas station. AMPM was the convenience store. The conditions of operation that the franchisee had to subscribe to in the convenience store was such that the SBA didn't think it made the owner-operator, sufficiently independent as a business. They were more like an employee of AMPM. So AMPM said, you want to buy an ARCO AMPM? Well, great, you can buy the ARCO part, but you can't buy the AMPM part. So if you drive around town, I don't know if they're still there or not, you used to be able to drive around town and you could find ARCO gas stations that were operating out of Bud's convenience store because of that. So the terms of the franchise will have a lot to do with whether it qualifies for SBA financing. The SBA has a list. I get a hold of my SBA lender and I say, hey, maybe it's a franchise I've never heard of. It's the, nice carpets are us or something like that. And you want to buy a franchise.
If I want to start, I've never started a taco store. I've never been in the restaurant business. I want to start a taco store.
Great.
Is that something that I could try to do? And SBA will say, yeah, we could potentially finance.
Again, they can make the call or I make the call. Doesn't matter who makes the call. But the call you want to make is to an SBA lender who has that sweet spot of fast food franchises. And it's not just fast foods. It's not just, restaurants. It's particularly type of restaurants. And you want to get a hold of them and say, I want to get this, Tacos R Us franchise. Is that franchise available with the SBA 7A? And they'll look at a list, pull it up and say, yeah, it's under the Tacos
not
under
even-
the T's.
Not even a franchise. Let's just say I want to start one. I have no restaurant experience. I want to start a taco shop.
Okay.
Is that something that's possible?
It's
For
possible.
SBA?
What you'd probably want to do, if you've never had any experience, remember I talked about the strength of the sponsor,
Yep.
is you want to get your brother-in-law who's clerked in a taco shop for 5 years and make him a partner of 20% or more. Can't make him a 10% partner. Doesn't need to be 50, but it's got to be 20% or more. You're going to ride his resume coattails for qualifying for the loan. Okay. Or alternatively, you can get the seller who will participate in a golden handcuff. Okay. The seller will stay on as a consulting manager, typically 2 years, to season the business, to make sure you don't do something dumb. Okay. So depending on what you got, they can be done, but they're, again, a lot of flexibility in how you make these things happen, depending on what the business is, what the franchise is, the strength or blind spots of the sponsor, what assets are available to him, both soft assets in the form of people, as well as assets to buy, and that's, if you haven't done a lot of these, these don't come up as something you can do. There's always ways to do things until you run into the blind spot, the blind alley where there's just nobody there.
Yeah. Well, I tell you, Mike, this has been amazing. I mean, the depth, the type of analysis that you got today was like kind of behind the curtain type stuff. A lot of the stuff that you wouldn't even know was even an issue, Mike has kind of wanted to at least put out there for you to say, hey, these are things that happen when you do a commercial loan deal. And those were great. Are there any concluding comments you'd like to make, Mike?
I don't think so. I think I'm spent.
Well, you did a great job. So anyway, so that was our commercial mortgage podcast. If you have any questions or you're looking to get a commercial loan, obviously you can see the depth and wealth of knowledge is here. We'd be happy to help you and try to give you the best direction we can to find the right lender for you. As Mike mentioned, that the lenders, they have different types of tastes for different types of projects. So we'd have to find the right lender for you to make this successful for you. So thanks again for watching, and we'll see you next time. Thanks.
Thank you, John.
Thanks,
Thank you.
Mike.
You bet.